Live from New York this morning. Good morning. About 20 seconds away from the opening bell. Equity futures going into it up 0.5% on the Nasdaq 100, up 0.4%, trying to build on the gains of yesterday's session, going into CPI tomorrow morning. The opening bell in New York City rings. Switch at the board and get to the bond market. Yields look a little something like this. They come in 4 or 5 basis points on a 10-year to 357.42 to start the year. A rally at the front end, the 2-year. The yield lower through most of the year so far, in the face of some hawkish Fed speak. Let's see if we get more of that later this week after CPI tomorrow morning. In the FX market, euro dollar holding on to 107 and having a little look at 108, 107.68, up 1/3%. And crude, look out for stock piles data later, up 2% on crude. WTI 76.60. About 20 seconds into this, equities up by 0.5% on the S&P, and the Nasdaq up by 0.5% also. The number one sector to watch at the open, the airlines. FAA system outages disrupting US travel, flights now resuming, and airlines feeling the consequences. For more, let's get to Abby. Hey, Abby.
Hey, John. Well, not surprisingly, Southwest is feeling the pain the most because, of course, just a couple of weeks ago, about 17,000 flights were canceled because of their outdated computer systems. So today, of course, we have disruption all over the map in the U.S. With the disruption relative to the notice to air systems missions system. It conveys advisory information essential for flight operations. That happened last night, and then it caused United Airlines to cancel all domestic flights this morning a little bit after 6:30 and then a little after 7. The FAA grounded all flights. Now the FAA has said that, quote unquote, normal air traffic operations are resuming gradually. They're working to really resolve these issues. Not surprisingly, all of the stocks are down, but again, Southwest the most relative to the overall impact for flyers today and the airlines today from a fundamentals perspective. 3,700 flights had been delayed until about 8:30. 640 flights were canceled. 21,000 flights domestically are expected to fly today. How much disruption works through the system, we don't know. But one really interesting thing, John, this is surprising to me. The airlines are one of the best sectors on the year, up nearly 14%. It's not entirely clear why, but today is just a small blip for these big gains. Take a look at that right now, up again about 14% on the year.
Yeah, today, what a run.
Yeah.
Abby, thank you. So not hugely disruptive for the stocks, but potentially hugely disruptive for you. Over at LaGuardia Airport, Kriti Gupta, Bloomberg's very own, joins us. Hey, Kriti.
Yeah, good morning, John. You are, of course, talking about those delays that Abby was just discussing. One of the key pieces of the equation is how much damage you are going to see throughout the rest of the day. Southwest, for example, very specifically saying in an email statement to Bloomberg News, talking about some of these schedule changes that are going to continue throughout the day. A similar story when it comes to United. They're talking about delays, cancellations, a lot of which are going to last through the rest of the day. The good news, though, John, is simply this idea that it's been a 1 or 2 hour delay for the domestic flights, which is throwing a little bit of the schedule into chaos. But going later into the day, a lot of the international flights, the real money makers for a lot of these airlines, they are still on track. You're hearing from a lot of the airports internationally. Think London Heathrow, Charles de Gaulle as well. They aren't seeing any interruptions, whereas, for example, Logan International in Boston, Atlanta, even Newark are starting to see a little bit more pain when it comes to those domestic flights.
Kriti, thank you. Looking forward to your reporting from there throughout the day on TV and radio. Bloomberg's pretty good to there. Another stock to watch, Apple, just about positive on the day by almost 1/10%, and rapidly going in the wrong direction, delivering another blow to suppliers. The company planning to start using its own screens in 2024, leaving partners like Samsung and LG behind. Ed Ludlow, they're dishing out the pain, aren't they, the last couple of days?
Yeah, they are. I mean, this is the latest in a series of moves. According to sources, this will materialize in the high-end Apple Watches as soon as the end of 2024. Technologically, it's about transitioning from OLED to micro LED, starting with those high-end Apple Watches, and then later introducing them to the iPhone handsets. As you said, particularly for LG, which derives around 35% of revenue from Apple, we saw their shares suffer in the Asian trading session. Really interesting because it's just, as I say, the latest Bloomberg report, according to sources this week, where Apple's not just thinking about the supply chain, John, in terms of where those components are made and where they come from, but also owning the technological control over what they're doing. Earlier this week, we reported, for example, according to sources, that Apple was moving away from Broadcom for its Wi-Fi Bluetooth hybrid modem or chipset and doing that in-house. It's really focused on chips as well. Also a blow for Samsung, which has significant exposure to Apple in terms of that display unit. It will be interesting, I guess, to ask the question, where will these displays be built? Will they be here in the United States? Is this an onshoring move? But as you say, the stock kind of pairing its early modest gains, now up 0.3%.
Hopefully we get some clarity when they report in early February. I think February 2nd is the date in in all our diaries. Just quickly, Ed, some news on Tesla as well. What are you hearing?
Yeah, so sources are telling me that there's a deal close with the Indonesian government to have a pretty comprehensive production plan over the long term in that country, a production facility for electric vehicles, kind of targeting 1 million units a year, which is kind of in line with Tesla's strategy globally. You'll remember that in August, Musk told shareholders that Tesla has plans to build between 10 and 12 factories globally, and this kind of 2030 target to have annual production of 20 million units. So, you know, we're hearing signals from the Indonesian government that this is taking place on the record, but according to sources, prelim talks, and of course, as with all deals, it could fall through. But interesting to see the stock buoyant this morning.
Ed, great reporting. As always, Tesla up by a little more than 2%. You brought a market up 0.5% on the NASDAQ at 0.4%. Katie Greifeld gets the challenge of the morning. Katie, you've got to explain what on earth is going on with this stock. Bed Bath & Beyond up 18%.
John, honestly, I can't, because there's a total disconnect between this company's equity and its fundamentals. It's up for a third day of gains, double-digit gains at that, up about 20% at the moment. That was 30% when trading kicked off just at the bell, along with some other meme names. But specific to Bed Bath & Beyond, of course, this rally comes with this company on bankruptcy watch. The company warned of that possibility last week. That was the focus when it reported a wider than forecast net loss yesterday. It also reported a cash and cash equivalents position of just over $150 million. That's slightly higher than 6 months ago, but really a staggering chart there. You can see that that figure, that cash position, it's down 88% from 2 years ago, John. Now, comp sales, they were even uglier. We're talking about down 26% in the third quarter. That follows double-digit declines in the previous 2 quarters as well. So again, this is a company struggling with inventory on the brink of bankruptcy, but you wouldn't know it by looking at the share prices, John.
Essentially a penny stock, the name all over the place. Katie, it's your job to explain that one, not mine. I'm not going there. Katie, thank you. Thank you very much. Another big debate for many of you I know. It's international versus the United States. What do you want to own? What do you want to buy? Morgan Stanley's Matt Hornback seeing a challenging backdrop for the US. We caught up with him just yesterday.
The fiscal trajectory in the U.S. could actually look much worse as we make our way through this year versus China fiscal policy and Europe fiscal policy. You know, those are pushing in a different direction. It's really the U.S. versus the rest of the world. And there, I think you can have some differentiation, which is, again, another reason why I think, you know, the U.S. dollar can go down as global growth outside of the U.S. picks up.
Amundi's Monica Defend echoing some of that sentiment, writing the following: earnings growth is too elevated, earnings are vulnerable to any economic downturn, the downside risks in the US are high, Europe is less risky, earnings expectations are weak. Monica, I'm pleased to say, joined us right now. So Monica, we've got to start there, and welcome to the program. Why is Europe less risky?
Well, it's what you saw in the street. Basically, when you go to expectations in the United States, they are still extremely high. Today prices do not reflect any sense of profit recession, which we do believe are in the cards in the U.S. So to this extent, and with the idea that the U.S. dollar is going to get weaker, then this is opening up in relative terms a window of opportunity of European versus U.S. equities, having in mind that you need to be overall cautious.
So help me clarify that. Is that a tactical call going into earnings season or a fundamental one with sustainable tailwinds? Which one is it?
Well, I don't think, I think it's more a tactical call. I mean, there are too many uncertainty ahead related to monetary policy, for example, and economic cycle that might prevent us for the time being to onboard structural positioning.
Let's talk about the bigger call that's taking place right now. It is buying international, it's getting long EM equities and buying into this China reopening story. And Monica, the debate we've had on this studio, on this program over the last couple of days is what on earth should I be pricing? A growth rebound off the back of this China reopening story or a growth slowdown off the back of the monetary tightening we've seen over the last 12 months? Which one is it?
I think that you need really to disentangle the various economic cycle. China is one story, is driven by the reopening, and they are going to struggle this winter and to catch up during the spring. When it goes to Europe, this is mainly dominated by the energy crisis, and we are seeing prices softening, and this might be of help. While in the United States, it's mostly about the monetary policy that we think will stop at 5.25, by the way.
Does that mean buy EM versus DM? Is that the call? Emerging markets over developed markets?
Maybe not really now, but approaching the end of the first quarter, that might be the case.
60-40 is your other big call. You say the 60-40 portfolio is reloaded. Can you walk me through why? Because that has been terrible over the last year.
Well, last year there was no other alternative to equity. Now, with the current yields level, there is some appeal that you might find out in the fixed income space. This is why you might expect this year, with rates moving higher, a rebalancing and a reappealing of these kind of portfolios.
From an income perspective, that probably makes a lot of sense to a lot of people, Monica, given where yields are at and given where yields weren't 2 years ago, 3 years ago, 5 years ago. Can you tell me about that portfolio from a diversification, uncorrelated diversification perspective? Can you tell me whether you think the positive correlation between equities and bonds does actually break this year and why you think that's going to happen?
I think this is really related to the inflation pattern. So anytime that inflation tends to stay high, this is having an impact on the correlation between equity and bonds, and vice versa. When inflation is moving lower, the correlation is getting to get inverted. And this is exactly where we do expect to be by the middle of the year, when we will see a regime shift from hyperinflation to inflation. And this is when you might shift from a mindset of capital preservation into risk accumulation. So mind the inflation pattern, mind the EPS pattern to shift your allocation by mid of the year and turning more positive.
Monica Defend, thank you. Appreciated catching up. Her views on this market right now, international versus the United States and bonds versus equities. At the moment, your equity market up 0.5%. 11 or 12 minutes into the session on the Nasdaq, up 0.5% also. Earnings season just around the corner. Bank earnings kicking off on Friday. Credit Suisse weighing big bonus cuts.
The slowdown in the economy and really deal making almost completely shutting down last year, these are not helpful factors for the bank.
That conversation up next.
the slowdown in the economy and really making almost completely shutting down last year, these are not helpful factors for the banks. However, there's one new thing, an additional factor, structural change, I would call it, that we haven't seen in the previous recessions or slowdown environment, and that's of course central banks hiking, and this is helping the overall banking sector.
Bank bonus cuts making their way to Europe. Bloomberg reporting Credit Suisse is considering slashing the bonus pool for 2022 by about half. This coming before the biggest banks on Wall Street report earnings. Bank of America, JP Morgan coming up on Friday morning. Team coverage starts right now with Bloomberg's Marion Hoffdemar in Zurich and Sonali Basak here in New York. Marion, first to you. Can you walk us through what you've learned about what might be coming over at Credit Suisse?
Right, exactly. So Credit Suisse is deciding its bonus pool for last year, and it's considering cutting that by about 50%. Now that comes after last year's bonus pool already being cut down by 35%. So this is just a continual cutting for these bankers. And that's off the back of, it's not been a great year for deal makers. So bonuses are down across the street. But also with Credit Suisse in particular, there's been a lot of issues lately, a lot of profit loss. So that's also factoring into this.
That's the question, isn't it, Marion? How much of this is a Credit Suisse story and how much of it is just a banking story?
Part of it is a banking story, and then there's the Credit Suisse element that you have to add on to it. It's been 2 years of problems, management changes, restructuring, and we're still seeing that come through. They just raised $4 billion in capital, so there's definitely a Credit Suisse tweak to this as well.
Sonali, I imagine Credit Suisse are not alone, and that it's not just the Europeans, it's the American banks too.
Absolutely. You have the bonuses being cut across the bank. So listen, John, it's easier for the bankers to cut bonuses than to cut headcount. And we are seeing a lot of headcount cuts, certainly on Wall Street already, but there's a lot of sense from a lot of these banks that they want to hold on as much as they can and really not signal to a lot of firms that they are not open to hire and open for business. Remember what David Solomon said just late last year, which is the talent war really isn't over. And once that bonus season hits, that musical chairs restarting again on Wall Street, the buy side picking at the scraps, that is something to watch out for.
Sonali, have you got names in mind that weren't able to hire the people they wanted to hire, and they're looking to pick up the pieces from the banks that could hire and perhaps overhired over the last 3 years?
You have to pay attention really closely here to the buy side after some of these big multi-strat funds have done so well, are able to really have some leverage on fees here. Big pension funds rethinking their hedge fund strategy after a year like last year and into a potential troubled time ahead. I would also look, even on the deal-making side, the top 2 deals of this year, a big presence on those deals were Evercore. It was an independent investment bank. So when you look at the competition in the big banks, even on the investment banking side, it's significant from players outside of the big 6. Lastly, let's not ignore the private credit firms, the private equity firms that are also picking at Wall Street right now after a really troubled year in leveraged finance that will keep these banks bleeding for the next couple of months as they've lost money on those deals and as the market itself has not really cleared and opened up yet. That means the private credit guys are really the ones with that dry powder and the ability to hire.
Sonali, let's set things up for Friday and the week after that. We had this graphic up a little bit earlier on the earnings we can expect. B of A, JP Morgan this Friday, Goldman the following week with Morgan Stanley. Just run us through things. What are you looking for?
Bank of America comes out with a note today saying it's Friday the 13th, and certainly it is. There's a lot of worries out there about the worst being materialized here. Remember, the big consumer banks, Bank of America, JP Morgan, Citigroup, certainly, they have fallen much more than you've seen the Goldman Sachs and Morgan Stanley's fall, which is not what you typically see in a cyclical business like trading and investment banking. Goldman has held up better than all of them in stock market trading. But remember, for Goldman, there's a lot of questions about the big reorg, the big investor day ahead. You just got the notification to register for the investor day this morning. And so a lot of stories to calculate that are very idiosyncratic, even aside from those big macro worries that could lead to potentially billions of provisions for loan losses.
You have got a busy Friday morning coming up, that's for sure. Sonali Basak with us on Bloomberg Surveillance throughout the morning on Friday, breaking down those earnings. Thank you. And thank you to Marion Hoffdemar as well, breaking down the latest reporting from our team on Credit Suisse. Your equity market at the moment positive by 5 or 0.6% with some sector price action. Here's Abby.
Hey, John. Yeah, we're looking at another gain for the S&P 500 at this point, up nearly 3% this year in just 7 days. It is on below average volume today, but not surprisingly with the gain, we have most sectors higher. In fact, at this point, 10 sectors are higher. Healthcare is down fractionally. Real estate, the best sector, up 1.8%. That That could have something to do with the fact that yields are lower. That could, in fact, of course, help lending activity, but it also makes the dividends of that sector look more attractive. Consumer discretionary, materials, both up more than 1%. Communication services and tech doing decent, up more than 0.5%, John. So today, a little bit of a risk-on mood, at least relative to the sector allocation. Let's check back in on the airlines. We were following them earlier on those flights, all domestic flights being grounded, and then that being lifted around 9 a.m. At this point, the airline index on the day is higher, up a little bit less than 1%, and on the year, this is just incredible, up more than 15%. This is sort of the surprising bull year, at least early on, John.
At least so far. It's January 11th. Let's
Yes.
see how that goes. Abby, thank you. Wonderful work, as always. Just getting some headlines from an ECB official. The Governing Council member, Olli Rehn, speaking in Helsinki, saying interest rates must still rise significantly. If you take a look over at euro-dollar, at the moment, the high of the session, 107.76, just off those highs on euro-dollar of 107.70. Compare and contrast this, and let's step away from Europe and look at the rest of the world right now. The rest of the world. Here's the global GDP forecast from David Malpass of the World Bank. Global GDP 1.7% this year. That forecast, half of what it was just back in June. Some perspective here. That would be the third worst forecast, the third worst year of growth in the last 3 decades, with the exception being 2009 and 2020. And just to put some numbers on it, US GDP, they're looking for 0.5%, Eurozone GDP, they're looking for 0%, and for China, in the low 4s. Now, I want you to compare and contrast those forecasts to what we're seeing in this market, just piece by piece. EM equities, back in a bull market. Copper prices, back through $9,000. European banks up more than 40% since the July lows. And even in the United States, high yield spreads the tightest since August. Tight, tight, tight. Tighter by more than 100 basis points from where they were just a number of months ago. The forecasters are telling you one thing, the market's pricing something else, and someone's going to be very wrong, and I imagine we're going to find out soon. Coming up on this program, the market moving events you need to be watching. That'll be next in our trading diary, live from New York City, with your equity market shaping up as follows. About 22 minutes into the session on the S&P, positive by 0.5%. Elsewhere on the Nasdaq, up by 6 or 0.7%. And in the bond market, going into the inflation report tomorrow morning. Your 2-year going nowhere, 4.25 on a 2-year. Your 10-year going somewhere. Yields lower by 4 or 5 basis points. 3.57 is your 10-year yield. From New York, this is Bloomberg. A second day of gains here on the S&P 500, at least for now. About 25 minutes into the session, equities higher by 0.5% on both the S&P and on the Nasdaq too. That's the price action. Here's your trading diary. Coming up, a White House news conference coming up at 2 p.m. Eastern Time. Fed speak from Harker, Bullard and Barkin on Thursday. That'll follow the US CPI report and another round of jobless claims. Then we just get the earnings deluge from the big banks. JP Morgan, Bank of America, Citi, Wells Fargo, all kicking off bank earnings on Friday. And we'll hear from Goldman and Morgan Stanley next Tuesday before we close out the week. We'll get the UMich Consumer Sentiment Survey as well. Can I just round things out with the recession debate? Neil Dutter of Renmac published in the last hour. He said many commentators continue to suggest that a recession is imminent in both the economy and earnings. I think the consensus is offsides. He said at least in the short run. Finish with this. Financial conditions are now easing and have been for a couple of months, supporting economic growth right now. Instead of long and variable, I think the lags are short and predictable. That debate is going to go on and on as we continue this year. From New York City, that does it for me. Thank you very much for choosing Bloomberg TV. This was the countdown to the open. Good luck for the rest of the trading day. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
So we're 30 minutes into the US trading day. It is Wednesday, January 11th. What stories do you need to know about? What are we following for you at this hour? After the FAA grounds all domestic flights in the United States, we're going to be live at LaGuardia with the latest as departures slowly resume. Jeff Gundlach says, listen to the markets, not the Fed. So how is the market positioned ahead of tomorrow's big CPI print? We're going to speak to Anastasia Amoroso of iCapital. She's the chief investment strategist over there. And with multiple mining stocks hitting 52-week highs and metal prices surging, we're going to hear from Goldman Sachs' head of global commodity research. He, of course, is Jeff Currie, and we'll be going up a little bit later for you. From London, I'm Guy Johnson. Alex Steele on assignment right now. She's going to be back in the next hour, I promised. Welcome, everybody, to Bloomberg Markets. So our top story is very much what has been happening in the United States. U.S. flights now starting to slowly resume. This after the FAA system outage that earlier grounded departures across the country looks as though it has been fixed. President Biden addressing the failure earlier as he departed the White House. He noted that there's no evidence of a cyber attack.
I spoke with Buttigieg. They don't know what the cause is, but I was on the phone in about 10 minutes. I told them to report directly to me when they find out. Aircraft can still land safely, just not take off right now. We don't know what the cause of it is. They expect it to be able to, in a couple hours, they'll have a good sense of the cause, and we'll respond at that time.
Apologies for all the background noise there, but I think we all heard what the President had to say. A positive note. Hopefully things are resuming. Hopefully things are getting back into the sky. Hopefully passengers are beginning to resume their journeys. Let's go to LaGuardia in Queens, where Kriti Gupta is standing by. Kriti, chaos earlier. What's the latest?
Yeah, chaos earlier, but you know, it was only a 1 to 2 hour delay for a lot of these domestic flights that were set to fly about 7 a.m., then pushed back to 9 a.m., but then put back into the air right at the 9 a.m. Eastern. One of the big takeaways, though, is you are still seeing some of the ripple effects for some of these airlines. Think United, for example, which has warned some of its passengers of delays and cancellations as a result of even that 1 or 2 hour delay. Southwest, of course, has already been dealing with its own issues when it comes to personnel. It says to an email statement to Bloomberg News that you should actually anticipate some schedule adjustments. That, of course, pushing the stock lower as well. So you are seeing a little bit of a ripple effect, but the good news, Guy, for a lot of these airlines are simply this idea that the international flights, the money makers, think London flights coming from London Heathrow, from Charles de Gaulle, those have been unaffected. Really, you're seeing a little bit more chaos in places like Newark, New Jersey. You're seeing them in Logan International and Boston, and of course the Atlanta airports as well.
What is your sense? What is the sense of the airport right now, and what is your sense of whether or not passengers are becoming sort of increasingly expectant of these kinds of things happening? Air traffic control delays are becoming more and more common. I'm assuming that Kriti can't hear me, so let's move on. Kriti Gupta at LaGuardia. Well, let's talk about what the President was referencing a little bit earlier on and talk about what this once again maybe signals about the vulnerability of U.S. infrastructure. We're joined now by Alan Levin, Bloomberg reporter covering aviation safety and the FAA. Alan, this may just be a system failure. This may just be a glitch in the computer software that the FAA is running. But does it highlight once again just how vulnerable the system can be? When one system goes down, you end up seeing a grounding of the entire domestic network in the United States.
Yeah, that's right. The whole air traffic system is based on the idea of ensuring safety. So if something goes wrong, they fall back very conservatively, and as occurred in this case, they halt all flights. Now, I want to emphasize that they never lost the ability to track planes or guide them or, communicate on the radio with them, and you saw planes were landing safely all day, but they acted with an abundance of caution and kind of shut things down. As we've reported, they're coming back now.
Alan, how sophisticated is this technology? How advanced is this technology? How secure is this technology?
So the FAA's computer systems, for years were criticized as being outdated. In the past decade, maybe 15 years, they've updated systems across the board, and so they're much more modern now. But I think it remains to be seen how updated this specific system was and what went wrong.
Do we actually have any knowledge about what did go wrong? Is it still possible that this could have been a hack?
Well, the information from the White House so far is that there's no evidence this is a cyber attack. And I will say, that the FAA takes extraordinary lengths to keep its systems separated from the internet, that is separated from the normal types of ways that hackers can get in and breach a system. But they have, I will add, been criticized at times by, whistleblowers and the U.S. Inspector General for not putting enough protections in place. I don't want to imply that that's the case here, but we'll see.
We simply don't know at this point, but as you say, the president may be pouring a little bit of cold water on that idea. Alan, when I've spoken in the past to the CEOs of US airlines, United is a case in point. They have complained about the lack of capacity within ATC. They see it as being one of the primary reasons why the aviation industry struggled to get back to pre-pandemic capacity last year, beginning of last year, and through last year. You talk about the fact that there has been significant investment, but is there need for more significant investment?
Well, it's interesting you bring that up because we've all heard the airline executives say that, but the data that they themselves report shows the exact opposite. In the past year, the airlines themselves were responsible for the vast majority of flights that were late. And if you look at data historically, the FAA's share of delays, that is delays that caused by the FAA's air traffic system, are significantly lower, maybe about half of what they were 20 years ago. So the system's become much more reliable overall.
Alan, thank you for the update. Really appreciate the insight. Alan Levin joining us on what we have seen, what we could see from the FAA. Coming up, we're going to push ahead to what the markets have been waiting for all week. That, of course, is the US CPI print for December. We're going to ask iCapital's Anastasia Amoroso how she is positioning for that data. That's next. This is Bloomberg.
Street prepares for the latest read on inflation.
There's new optimism about a soft landing.
Inflation may be fading faster than some people thought.
Will headline inflation continue to ease?
It's really about the labor market, wage inflation, and services.
Peak inflation becomes your number 2 concern, and you get into a growth discussion.
Instant reaction on Bloomberg Surveillance.
This is good news for Chairman Powell.
Risk of doing too little, does it still outweigh the risk of doing too much?
How much do we see the worst of it versus just the beginning?
Inflation in Focus, Thursday on Bloomberg.
The Fed funds implied rate by the yield curve, the Treasury yield curve, has really become remarkable, where we see that the bond market pricing shows that the Fed is not going to make it to 5%. They're going to make it just under 5% by May or June.
That was, of course, DoubleLine Capital CIO Jeff Gundlach speaking last night. He went on to say this: my 40-plus years of experience in finance strongly recommends that investors should look at what the market says over what the Fed says. Well, tomorrow we're going to get the latest read on inflation with December's CPI print. So if we're listening to what the market says, what message is the market sending about inflation? Our question of the day, a fairly straightforward one: how do you position for CPI? Well, let's ask that question to Anastasia Amoroso, Chief Investment Strategist at iCapital. Anastasia, welcome. Nice to see you.
Good.
What do you think about tomorrow's number? How are you getting ready for it?
Well, I think tomorrow's number may actually add to the string of positive surprises that we have seen on inflation. I mean, you know the consensus is looking for a flat or slightly negative month-over-month print and core inflation to come down to 5.7%. This would be huge, and I think there is a good chance that we get something in line with that consensus numbers. The reason I say this, guys, because if you look at components of CPI, all of them slowly but surely have been adding to this lower inflation narrative. I mean, for example, look at the goods component. The goods CPI was running at 16% year over year sometime last summer. It is now running at 5.3%. And if you look at the month-over-month numbers for goods inflation, it's actually deflationary now. So that's a great development. Whether you look at fuel, whether you look at fertilizer, some of those prices have started to come down. And then, of course, we've got the wage report last week, which showed that wage inflation eased from 5.6% to 4.6% year over year. So you add that together. You look at, some of the recent rent prices that we have been getting, and they're starting to ease off too on a month-over-month basis. So I think it bodes well for the number tomorrow. And to your lead-in point here, which is maybe we should listen to the markets. Well, that's what the markets are sniffing out right now, is that we might actually have a string of positive developments on inflation.
You say the market's sniffing it out. Hasn't the market already sniffed it out? Isn't that what's been priced? Isn't that what we've seen in terms of the rally that we've been getting? Isn't this already discounted? And if it is, don't we need to see a really soft number, therefore, to get equities to move tomorrow?
Yeah, but I still think, if we get confirmation, I mean, look, we have not priced in 100% probability of a soft number. We've priced in some sort of probability. So I agree with you. That's what's driven the market. But I think if we get a positive surprise, if we get in line, that's still the reason for optimism. That's still the reason to cheer. So I think the market can still move on that.
Here's my question, though. If we get a soft landing, if inflation does come down, and we actually see the U.S. economy performing relatively well during this period, isn't the Fed just going to stick around 4%, 5%, dare I say it, 6% in terms of rates? Why would the Fed be cutting if the U.S. economy can tolerate the kind of rates that potentially we should be seeing?
Yeah, it's a really good point, and I don't think the Fed is going to be cutting rates once they get to 5% if the economy is reasonably well behaved. I mean, they have told us they want to get to 5% and they want to stay there. And here's the thing, guys, this economy seems to be digesting the 5% interest rate just fine. It is digesting this through weaker economic growth, which is exactly what the Fed wants to see, but not necessarily much higher inflation numbers. So I don't necessarily think they actually want to cut.
So if the U.S. economy is tolerating it, and Neil Dudler was talking about this, John was referencing it in the last hour, talking about the fact that the U.S. economy is actually doing just fine right now, is that a good backdrop for equities? Theoretically, I would have thought that it would be. High rates, but a U.S. economy that's doing okay. Which asset class do you think performs best in that environment?
Yeah, look, I think there's a number of opportunities across asset classes. I do think that equities can perform in the environment where rates are, 5%, as long as the economy sort of had the soft landing. Look, Guy, the biggest challenge for equity markets has been, well, twofold. The valuations needed to reset, and that we needed to price in this growth slowdown or this recession that everybody was fearful of. And first of all, valuations have reset a lot. If you looked at them last year, they were the 90th percentile or more over the last 10 years. Today, they're sort of middle of the road. They're not cheap, but they're not expensive. But you have pockets of the equity markets that have reset a lot, like software, like semiconductors, like some of the most expensive stocks. So I like the fact that that has already reset. And, no, the valuation expansion is not what's going to drive us going forward. But I think if growth stabilizes and, manages to still run, let's say, 1.5% GDP, that will eventually translate to revenue growth and earnings growth that can return. And the other reason, Guy, I think that equities can eventually rebound even in this 5% rate environment is because companies are going into self-preservation mode, and they're going into, let's preserve the margin, let's work on that. So they're unfortunately cutting jobs, but that helps preserve the margin. They're paring back the share buybacks. They're reducing CapEx. And so the equity markets like to see those profit margins sort of reverting back, if not towards the highs, then, off the low levels. And I think that's likely the development that we're going to see in the next couple of quarters. And right now, the margin pressure, is really affecting certain sectors more than others. It's information technology, it's communication services, it's financials, and that's where you see most of the cost-cutting pressure. But I think that probably broadens out, and once it does, and once you right-size the cost side of it, you can have a pretty significant snapback in margins once the economy stabilizes.
Okay, you're talking about things that are happening in the future here, and you spoke a moment ago about the fact that eventually stocks may come back. Is it still therefore too early to be significantly getting back into the stock market? Do I, as a lot of people are doing at the moment, favor bonds first, equities later, or is now the moment to strike? Is now the moment to be getting back into equities?
Well, Guy, I think investors today have the luxury of sort of doing both. And what I mean by that is you can be defensive and opportunistic at the same time. And, maybe we're still uncertain for the first half if this is really, we truly have seen the bottom, or this is really, truly the recession. And let's face it, the Fed is still going to try to knock the market down anytime the market tries to rally. So with that in mind, I do think it makes sense to play defense in the portfolio. And guess what? There's so many more opportunities to do so. There's cash equivalents, there's high quality fixed income, there's private credit. So you can have a balance of your portfolio that gives you a very decent income stream, and so you can play that defense. But at the same time, I think we would be remiss if we didn't look at the opportunity set, across equities, across, private markets where we have seen a meaningful reset in valuations. And the thing to not do is to invest it all today. The thing to do is to have a plan and say, over the next 3 months, to 6 months, methodically deploy some of that capital into the opportunities where valuations have reset. And the reason I say 3 to 6 months, Guy, is because by middle of this year, I suspect the interest rate will be at 5% or more, but core PC inflation will likely to come down to 3.8%. So at that time, you will finally have this gap that will give the Fed wiggle room, and if they have to cut, they might actually do so. So that's why that's sort of the time horizon and the point of a turnaround. But the point is, you want to commit today to deploying that capital over the next 3 to 6 months.
Okay, we'll leave it on that. Fantastic as ever, Anastasia. Thank you very much indeed. Anastasia Amoroso, Chief Investment Strategist at iCapital. Okay, still ahead, Tesla eyeing Southeast Asia. The company is said to be close to securing a deal for a third plant outside of the United States. Details as to where that plant could be coming next. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Advisors to the failed crypto exchange FTX have found more than $5 billion in cash or sellable crypto assets that may help repay creditors. They've also told a bankruptcy judge they found other crypto assets that are liquid. FTX hasn't figured out how much money creditors will get back. After years of scandals and multi-billion-dollar losses, Credit Suisse is tightening its belt. Bloomberg has learned the Swiss lender is considering cutting the bonus pool for 2022 by about half. The move would bring the amount down to about $1 billion, with some employees likely to receive no bonus at all for last year. And Bloomberg learned that Tesla is close to sealing a preliminary deal to set up a factory in Indonesia that would allow Elon Musk's electric car maker to capitalize on the country's reserves of metals used in batteries. The plant would produce as many as 1 million cars a year. And that is your latest business flash. Guy?
Okay. Well, let's carry on with that story. Ritika, thank you very much indeed. 22 minutes past 7 on the West Coast. Let's get the startup tech stories covered from the Bay Area and beyond as Silicon Valley starts this morning. Joining us now is Bloomberg's technology co-anchor Ed Ludlow, who this week is in New York, not in San Francisco. Ed, let's talk about this Tesla story. Fantastic story, by the way. Is this about the Indonesians saying, if you want the metals, you need to build the cars here?
I wouldn't say it's as quid pro quo as that. I mean, sources tell us that this very much comes from the Indonesian side, right? You'll remember that the president of Indonesia visited Elon Musk last year. They do have an agreement in place for battery metals. But what we're hearing is that, Indonesia and Tesla have been in talks, according to sources. This is kind of in line with Tesla's broader strategy of global manufacturing expansion. But I think what Indonesia is trying to do here is much broader, which is offer itself as a great place to develop supply chain for electric vehicles more broadly, beyond just the metals.
Do we know how big it could be? Where it would serve, what kind of operation we're talking about?
Yeah, look, Elon Musk told investors in August that, long-term, Tesla's going to need 10 to 12 gigafactories globally. And in their 2021 impact report, which was published last May, they had this kind of 2030 goal of 20 million units a year. So that, is in line with the idea that this EV facility would be able to do 1 million units a year. What one source told me is that actually there could be several facilities around Indonesia that serve all parts of Tesla's EV supply chain. Just as with all negotiations, sources making clear that the deal could fall through. But it is kind of making sense, right? And I believe that Indonesia's investment minister told my colleagues in Asia, or confirmed that the talks are taking place and that they're being handled by a specific agency. So it seems like very early days, but it's building on an existing relationship, and it is in line with what Tesla has said about its long-term ambitions.
Ed, quick comment on Apple. It seems that every day this week we've had a news story about the fact that Apple is taking yet another component in-house. This time I understand it's screens, which is going to hit Samsung. How long before they do it all?
Yeah, so fantastic reporting from Bloomberg's Mark Gurman. According to Bloomberg sources, as soon as the end of 2024, starting with the high-end Apple Watch, Apple could move away from LG and Samsung and start doing the displays itself. This is about transition from OLED to micro LED. LG has about 35% of its revenue coming from deals with Apple for the displays. Longer term, according to sources, the idea beyond 2024 is to get those displays for the iPhones themselves and other products done in-house. But as you said, it's not just about sort of sourcing the components, it's about having complete control of the technology. Really interesting move.
Is this going to be, to my point though, are there components which are still manufactured out of house by sort of second and third parties, tier 1, tier 2 suppliers, that ultimately Apple has got its eyes on here? What comes next after this? What's left after this?
Well, we don't know. I think the biggest question is where they're manufactured as well. So we reported earlier this week about moving away from Broadcom for the Wi-Fi Bluetooth modem and doing it in-house. The question is, where are those chips manufactured? Does TSMC do them in Arizona? There's also a geographic component, right? Part of this is de-risking from China, and we know Apple's been moving supply chain to India, but these are slow-moving developments.
Ed, great stuff. Fantastic reporting on both stories there. Thank you very much indeed. Bloomberg's Ed Ludlow. Coming up, we're going to talk about commodities from a different angle. Oil edging a little higher on optimism around China reopening. Goldman Sachs says that could mean $5 a barrel more on the 2023 price. Jeff Curry joins us shortly. This is Bloomberg.